let's commence the session. So let me have the pleasure of inviting Dr. Indrajit Coomaraswamy, former Governor of Central Bank of Sri Lanka, to deliver the keynote address of this expert panel discussion. What is next for Sri Lanka in the wake of IMF program? Over to you, sir.
Thank you very much, Kushan. Let me express my gratitude to the Governor and to Dimuthu, who is the Director of the Center for Banking Studies, for inviting me. It's a great pleasure to be with all of you. This is a timely topic as the EFF has now been successfully negotiated. But this is in some ways the beginning. There's a lot more to do. And it's time we started thinking about what has to happen next. But before I get into that, and I'm going to be very brief because I understand there's a very large viewership and many people want to ask questions, so I want to maximize time for that. But let me first start by reminding all of us where we were a little under a year ago, when there were acute shortages of the most essential goods. There were long queues. 1 or 2 people actually passed away in the queues, and the prices were skyrocketing. The exchange rate was collapsing, and the inflation was going up, and the central bank was compelled to push rates up dramatically. All this was happening in the last, within 6 months, 9 months of where we are today. So the fact that things have stabilized to a significant extent clearly is a very favorable and very positive outcome. But there's absolutely no room for complacency because the stabilization has taken place at a low-level equilibrium. The stabilization has taken place when the economy has been contracting by, I think the Census and Statistics number was, I believe, about 7.6% contraction last year. I mean, that was better outcome than what was anticipated by the IMF and the World Bank, but still, it is a very sharp contraction. And we need to get to a situation where we have stability, macroeconomic stability, when the economy is growing at, at least 4%. So there's a lot to be done, and we shouldn't forget that. But this is a very commendable place to get to. The fact that the Paris Club has endorsed our efforts to get to move to debt sustainability, and the Paris Club, of course, includes the G7 countries. Then on top of that, amongst the non-Paris Club creditors, we have India and China. So the largest and most important countries in the world have indicated that they're willing to support Sri Lanka to get back on track in terms of debt sustainability. So that's not a bad place to be. But we have still got some work to do. That's going to be a recurring theme you're going to hear from me. So what do we need to do next now that we've got to this point? One is, I would say that I'm going to use a cliche, the 3 most important priorities going forward are going to be implementation, implementation, and implementation. That has always been a weakness for us. And it's a tough program, but we've already done a lot as prior actions. But there is more to do, as you would have seen from the documentation that was tabled in Parliament, including some tough structural reforms and institutional reforms. So we need to have a laser-like focus on implementation and go through with the program. Because if the program gets suspended, it would have pretty dramatic consequences. So we need to keep it on track, and we cannot relax. We cannot think that we have achieved more than we really have. And we cannot give up the absolutely compelling need for discipline in a way we have never exercised discipline before. So those things have to be there as we go forward. When you say what is next for Sri Lanka in the wake of the IMF program, it is discipline and a very different way of making economic policy, and in terms of implementing what we have agreed to do. People say that the IMF have had 15 IMF programs or 16 IMF programs, and they've all failed. Well, most of the time, the problem has been lack of implementation on the part of the Sri Lankan authorities. So the fault has been mostly ours. Occasionally there's been exogenous factors that have thrown the program off track, but that's in a minority of cases. So we have to do things differently and maintain discipline. So what are the things that, specific things that we need to do? Let me just give you one or two of them. One is just earlier this week, Dr. Chandranath Amarasekara, our alternate executive director, arranged for the Irish alternate executive director to brief the governor, ST, the president's chief of staff, on the implementation unit that was set up in Ireland when the global financial crisis hit Ireland and they had to go into an IMF program. And it was very, I think we need to be grateful to him for sharing with us in great detail what the Irish did. They were very meticulous in the way they set up an implementation framework. They identified all the actions that had to be taken, and some actions they even split because more than one authority was responsible for it, and then had this matrix where you had the actions and the sub-actions, and each of those was ascribed to a particular government entity to implement. And this particular unit reported directly to the Irish Prime Minister, who's the head of government in Ireland, reported directly to the Irish Prime Minister and the cabinet. And the reporting happened once a month, and wherever there were bottlenecks or impediments which were constraining the implementation of any aspect of the program, those were immediately dealt with. And with the benefit of hindsight, it is now agreed that Ireland was one of the most successful countries in terms of implementing an IMF program. They got it done, and they've now, basically they moved well away from the imbalances that were there in the economy at the time of the global financial crisis, and they are back on track. So we need to do the same thing. We need to have the same degree of focus, absolutely a laser-like focus on implementation. We need to figure out what has to be done and then ascribe a responsibility for each of the actions and monitor very carefully how we're going about it, and to make sure that we are hitting all the targets and the structural benchmarks as we go along. Because these targets and structural benchmarks are embedded in the IMF program, and as we go forward, we need to make sure that we keep on track. But the last thing we need is for us to suddenly find that we have gone off track on the program and the program is suspended. Because that will, basically constrain the flow of funds to the country. It will affect the confidence that is beginning to build up now with the signing of the EFF. So all that will get undermined if the program gets suspended because we are not able to keep it on track. So this implementation unit, which I think the president was very interested in, and which is why we had this briefing from the Irish alternate executive director, we need to get it set up, and it needs to be functioning, and we need a very good person who has the authority to basically reach out to any part of government and get things done. And it should have the authority of the president behind it. So that's one thing, implementation. Another thing that we need to look at is really, there is now, we have got to the point where there will be a different type of focus on the debt restructuring. Up to now, the focus has been on getting assurances of financing from the bilateral donors and an endorsement from the commercial creditors that we are cooperating with them, and there is progress being made in terms of addressing the commercial credit that needs to be restructured as well. So far, I think a great deal of credit has to be given to everybody concerned. That we've got to where we are. As I said, the Paris Club has all the G7 people in it. India, China, all of them have come forward and given us the assurances of financing that we require. and all of them in pretty generous terms. There is a great commitment to assist Sri Lanka to get out of this mess. And we need to now demonstrate that we actually deserve it by showing discipline and commitment on our side. And on the commercial credit side too, it's unprecedented as far as I know for commercial creditors to issue the kind of statement that the commercial creditors did about, I think maybe now a couple of months ago or 6 weeks ago, to say that they are happy to collaborate with Sri Lanka and to work with Sri Lanka to complete the restructuring of the commercial debt. So that's something that's unusual. And again, everybody, the authorities need to be commended for getting that kind of response from the commercial creditors, because I think the authorities have been at great pains. Governor and ST have been briefing all the creditors. They've done so more than once to make sure that everybody has the same information and that the whole process is transparent. They have taken trouble to do that. And I think the response has been very favorable in terms of the attitude we've seen amongst the creditors, because we've got pretty much everything that we wanted. And so now we're in a position to move forward. So, but this program is extra tough because we are trying to implement stabilization cum structural adjustment program and do the debt restructuring all at once. This is unprecedented for us, and that makes it more complicated to get the implementation right, and it makes it even more important to get this implementation unit well structured and running well. So that, but before I finish, because I want to finish quite quickly, I'd like to address a few things that have been said about the program. One thing is people say that, you know, when the IMF comes, there's going to be massive austerity and, you know, basic services will be cut and the poor will suffer, etc. Well, on this time around, from the second quarter of last year, there has been massive austerity. The IMF was nowhere on the scene. We hadn't even started talking to the IMF. Yet, we found great shortages, prices going up, people on the streets, all this was happening. And the IMF was not on the scene. So you can't say that it's the IMF austerity that caused those problems. Because what was happening at that time was because we didn't go to the IMF, we left it very late, which made the problems even more severe. What happened last time is that we were having to do the adjustment. The stabilization had to be done without any financing support, without a cushion being provided by inflows of external financing. That is what the IMF does. The IMF, yes, comes in when a country's, there are imbalances in a country's macroeconomy, and it requires a country to then basically take austerity measures to bring the macro indicators into balance. But what it does do is to provide financing, first of its own accord, and secondly, it catalyzes other financing to make the adjustment somewhat more palatable. We were doing adjustment without any financing support because we didn't have the IMF by our side, because we started very late. So now we have got to a situation where quite a lot of the adjustment has already taken place. Taxes, the exchange rate, interest rates, all those things have now adjusted to a significant extent, and we had to do it without any financing support. Now the financing support will come. There's still a bit more adjustment to do, but it is hopefully we are in a better place where we can particularly support those who are most adversely impacted by the stabilization policies. Because the government has given the highest priority to strengthening the social safety net, and they are ramping up some of the cash transfers and rationalizing the social safety net and designing it better so that those who need help will get help. Others, I'm sure, will say more about it. So that's another point that needs to be made, that this program has a strong social safety net dimension. Yes, there's fiscal adjustment, there is revenue adjustment, there is expenditure control, all those things are there. But side by side with that, there's going to be a great effort made to build up the social safety net as well. So let me, the final point I want to make is that if we want to get out of this in a sustained way, we have to do the structural reforms which will strengthen the growth framework of the economy. Many times in the past, we've had these EFF programs, which have both a stabilization component and a structural component. And in the past, at least at the beginning of the program, we do relatively well on the stabilization side. We get some fiscal adjustment, so the inflation comes down, the BOP gets better. But as soon as there's a political event or like an election, it all kind of falls down. But even though we have made some progress on the stabilization side in the past, very, very little progress has been made on the structural side in any of the past programs. In terms of building an export-oriented economy, a competitive export-oriented economy, we have made remarkably little progress. Way back in 1978, President Jayawardener said, you know, export or perish. But those words have been pretty empty all the way through. Most of the time, the last 40, 50 years, we've had an anti-export bias in our policy framework. The exchange rate, the level of protection, the para-tariffs which have excluded us from the global supply chains. All these things have been clearly known for many years, and we've done very little about it. Trade agreements which could have boosted the export transformation, trade facilitation. None of these things have really been done, nor the effort, the agenda that's there to improve the competitiveness of the economy in terms of improving the business climate. We know about all this. We have talked about all this for a long time. This time, if we don't do it, we could either sort of end up like Argentina and be a serial defaulter, as I said, or else we fall by the wayside by countries like Zimbabwe and Lebanon. So let me finish with that. It's a bit of a downbeat note to finish, but having said that, I must say that so far, we've done pretty well. We've done pretty well to get this program done in difficult circumstances. A lot of tough measures have already been taken. We just need to sustain that, keep those measures in place, and do what else has to be done as laid out in this program, and have an implementation unit that will drive it. Thank you.
Thank you, Dr. Indrajit, and thank you for providing the context to this discussion, and I'm sure we'll get into more positive things as we go along in the next 80 minutes as well. So to everyone tuned in, my name is Shiran Fernando. I'm the Chief Economist at the Ceylon Chamber, and I'll be guiding the discussion in the next 80 minutes, 85 minutes that we might have, all the way till 5 p.m. What we'll do in the next round of discussion is I will open it up to my panelists.
Shiran comes, so the expectation is to give a quick 6 minutes overview of what's beyond IMF kind of thing, not looking at the typical reforms that they're planning to do. So the first thing that I would like to say is like Dr. Indrajit said, we are not out of the woods. We have to be very clear on that one. We just got there. I mean, getting this EFF done in a 6 months period, I think outstanding work compared to some of the countries like Zambia and Suriname. I think Sri Lanka has done very well in terms of getting this on time. So that is a a big win, but let's not over celebrate this, because we might forget what we went through last year. So I think in terms of reforms, IMF has, of course, there are multiple targets in terms of fiscal reforms. There are specific targets set on debt to GDP as well as fiscal surplus, etc., primary surplus by 2025, etc. But I would like to touch on a few things. So a lot of people are of the view that we'll immediately get a rating upgrade. So we had to be calm and wait, because we had a cross-debt restructuring. I think government will announce the restructuring parameters in April. So post that, hopefully we'll have some clarity. And there's something called the debt exchange that you sign a document, and then hopefully after that there'll be an upgrade. To what level we don't know, but all depends on how you commit to the reform program. But going beyond what IMF is basically asking us to do is something that we all talk about, the government sector. I think we have about 1.7 million people. We have to repurpose and resize, because we always think that we have to exit everybody. We can actually come up with a repurpose plan where you repurpose at least 500,000 government sector into different things. You get the productivity up. repurpose and of course then resize. I'm not a big fan of trying to save money from the government expenditure, government salary bill. That's about slightly over $1 trillion, 1.2 trillion. But we should seriously look at paying the right people better, because otherwise you will not attract good people into the government sector. I don't have to tell you the amounts that we pay for doctors and some of the professionals in the industry. We can't retain talent at that level. I think we lose about 50 doctors for a month as we speak. So that's a big piece that we have to fix. Of course, IMF will give a broader guideline, but at a ground level, we have to fix that. One, to be efficient and to take decisions very quickly. The other one is, we will get some money from ADB World Bank. Of course, there's EFF. But we need to find capital. That capital can only come through FDIs, and FDIs are rare these days because the global markets are struggling and capital is rare. Forget the cost, capital is rare, difficult to find capital. So if you're expecting FDIs to come in and investments to flow into Sri Lanka, we should really understand why they should come to Sri Lanka. And our investment policy is not very stable. So we come up with something, we want to do something, we sign up, and another government can come and change it for a couple of years or forever. So that has happened many a times, and also our tax structures have changed multiple times. So our investment policies have to be, really documented at a constitutional level. There should be constitutional laws where the governments cannot change the investment policies. And we need to clearly understand what will take the GDP to the next level. Because I've seen the predictions by the authorities as well as from IMF. I think we are forecasting 2.5–3% growth. I think that's way below for Sri Lanka's potential. Of course, this year is difficult. Next year also will be difficult, but Sri Lanka should be firing above mid-single digit in our view, because if you look at the other emerging markets, Sri Lanka has that potential. So it's very important for us to understand the strategic pillars to take the economy to that level, and make sure that the platform is well documented and legalized. Basically, there's a legal framework around it. So when the government changes, people cannot come and change the investment policies. I'll stop there. More to talk, but I'll stop at that level. I mean, other panelists will join me. Thank you.
Thanks, Bingumal. I can be heard right now, right? Great.
Very well.
Super. Thanks for picking it up. So we'll move into Deshal and then Murtaza for opening remarks.
Thank you, Shiran, and thank you to the Central Bank for the invitation to speak this afternoon. Let me take on from where Indrajit and Bingumal left off. So I just want to share a little bit on my perspective as to why this is an important milestone, the IMF board's confirmation of the EFF program. This is, I think there's been a lot of sentiment as to why is Sri Lanka celebrating getting a loan and things like that. I would look at this differently, because an IMF, when a country gets an IMF program board approval, it indicates the IMF's endorsement of that country's economic reform program, of the ongoing economic reform program, and that is particularly important for a country like Sri Lanka, which has, as was mentioned earlier, this time last year, that confidence had evaporated completely. We had no access to, let alone capital markets. We had very little access to even trade financing markets. So restoring that confidence is a really crucial milestone on that path to recovery, and this is a very important part of that process. And I would say that what it indicates to the global markets and also to domestic markets is that Sri Lanka is now on a path of reform that can address some of the fundamental issues in our macroeconomic structure. And that is what really then signals to market players that, look, this is a country that is worth engaging with at a more serious level going forward. And that is really a crucial element. And I think that part is a lot more important, that credibility and that confidence is a lot more important than the magnitude of financing that the program itself unlocks. But that's not to say that the financing is irrelevant or trivial. I think given Sri Lanka's context, in the extent of difficulties that we have, there are some very important shifts that the financing can bring as well. So if you look at it from two angles, first in terms of the difficulties we have faced in terms of foreign exchange liquidity, and also the challenges that we have faced in our fiscal cash flows. Both have been very pronounced over the last 12 months or so, and have made the lives of ordinary Sri Lankans very challenging as well. So already we have seen the improvements in terms of the foreign exchange liquidity purely on the expectations of the IMF program coming into being and the resulting improved sentiment and expectations around that. So we've seen that has been reflected in some of the foreign exchange market transactions that we've seen over the last few weeks, and also the ability then of the central bank to also build up reserves on the back of that, that improved liquidity position. What is possibly maybe less understood is also the implication that this has for fiscal cash flows. Now, again, over the last, since early 2020, Sri Lanka has not had access to any kind of foreign financing of the budget. And during this period, the budget deficit also increased to double-digit levels. So we had a situation where the entire budget deficit was being financed by purely by the domestic market. And part of that was, of course, monetary financing that contributed to the very high level of inflation that the country experienced during the last 12 months. So this milestone of getting the IMF endorsement and initial financing that comes through, and also unlocking the potential financing from some of the other multilateral agencies, that creates the first tranches of foreign financing of the budget as well, and that eases the pressure that is existing now on the domestic financing market, eases fiscal cash flows, and now that will basically also enable interest rates to come down to some extent, and reduces the requirement of monetary financing that will help anchor inflation expectations as well. So those create very material, important changes at a very early stage in this program. So they're already starting to see some of those positive developments. We've seen inflation reducing, the pace of inflation declining at a faster rate that had originally been projected. We're seeing an improvement in the reserve position. We're also seeing improvement in the fiscal outcomes as well at early stages. So in addition to the longer term confidence building that the IMF program brings, we also have these important short term implications as well. Now it's critical that Sri Lanka is able to continue on this path so that we see through that whole process of, first, as Bingumal also mentioned, being able to upgrade our credit ratings as we move forward, with the final outcome of being able to restore access to global financial markets. And that is really the point at which we can say Sri Lanka has come to a certain level of recovery. So this is a crucial milestone in what is still a long path of recovery. And it's important that we are able to stay the course. Let me end there for now.
Thanks, Deshal. Murtaza, I can have you in.
Thank you. I have limited time, so let me focus my thinking. The first important thing to say is that I know it's fashionable to vilify the IMF, to bash it, but 75 years after independence, it's a national pastime for politicians to play to the gallery. And there's a whole bunch of people, whole bunch of crackpots at the lunatic fringe who basically have nothing better to do. And instead of really focusing their efforts of trying to go after the people who created this crisis, it's fashionable to bash the IMF. The IMF is here on our invitation, and they are providing our funds to stabilize our economy. So we should be thankful to the fund to have come to our rescue at this time of need. The second important thing is, if you are a conscious Sri Lankan, it is your obligation to read the Memorandum of Economic and Financial Policies starting in page 84. That clearly lays out all the things that we have agreed to do. This memorandum is something that we are putting forward. We are saying we are going to do those things. They are not telling us you should do these things. So, and many of the things that we are saying we are going to do is things we have been saying we are going to do for the last 20 years, some things like 30 years. For example, SOE reform. It started, in my recollection, in the 1980s under Premadasa peopleization. So this is a continuation of a 40-year journey, basically. Second is about central bank independence. I have been hearing about central bank independence for 25 years. In fact, when former Governor Coomaraswamy was in charge, he was in the cusp of getting it approved in Parliament. So this is nothing that's new. This has been in the national debate for many years. bulk accounting of the CB. I remember 2002, 2003, we tried to do it, and the government changed and it didn't happen. So most of these ideas are the work of us. These are homegrown programs. Just because it is in an IMF document, it doesn't mean that they are telling us to do. This is such an important thing, because our hearts and minds have to be behind these reforms. This is for our benefit. This is not for somebody else's benefit. The next thing that I have is that we have a significant balancing challenge. So you have the taxpayers through which channel the fiscal effort is coming, and then you have the creditors. Now, the issue that I have is that everybody who can afford to should participate in this adjustment program. You can't cherry pick some people and say, no, you are holier than thou and keep you out. So take, for example, the tax. So government finally took the right decisions and said 30%, all companies you will have to pay irrespective of whether you are an exporter or making construction or manufacturer. It makes sense because profit is profit, right? You only pay taxes after you make profit. But the problem that I have with the tax policy of the government currently is that some people got exempted. That doesn't seem to be very fair. So for example, if you are a service exporter whose service is consumed in another country, you are exempted, which doesn't mean that you are enjoying a concessionary tax rate. You are paying zero. So for example, if you're a software engineer and you're earning $5,000 a month, which means about over 1.5 million rupees, the minimum tax threshold for anybody else is 100,000 rupees. Here is a person earning 1.5 million rupees exempted. You don't have to pay anything. That doesn't seem very fair. Then you have these BOI agreements that have been signed maybe 10 years ago, 15 years ago, 20 years ago, that gave you concessionary tax rate, zero tax rate, and a concessionary tax rate forever. No sunset clause, forever. So you have a situation where two companies are competing. One company is at 15%, somebody else at 30%. That doesn't seem to be very fair. And there are other cases where they have given under the Strategic Project Act 25 years tax holidays. These are all agreements. Now, once you have defaulted on your creditors, there are no agreements that are sacrosanct anymore. Then you come to the debt. So there is talk that if there's a domestic debt restructuring, certain people will be exempted and certain people will have to participate. My belief is it should go instrument-wise. Everybody should participate. Because if you argue the case that, no, we can't have domestic debt restructuring for basically the banks, you are bailing out. It's not a question of the depositors. I don't think it's going to come to that. But you're bailing out the shareholders and the tier 2 bondholders. So again, my sense is what's next? It should be fair that everybody who can afford to should pay the price. The next important thing is a social security net that Dr. Coomaraswamy talked about. The only point I want to say is if you read the document, there is a ceiling on that. What it is saying is in order for the government to achieve its primary balance targets, it cannot achieve it by reducing that. It's a flow. I made a mistake. It's a flow. You have to spend that. If you try to achieve your primary balance target by reducing that, you have to adjust through something else, basically. Right? So this is something that the people that the IMF has made a conscious effort to ensure that that is not compromised under any agreement. And that is only humanely to do that, because the income distribution in Sri Lanka, 36% go to the top 10% of households, the bottom 10% only get 1.6%. They are in a really deprived situation, and it is the obligation of a country that calls itself the Democratic Socialist Republic to make those transfers. And finally, basically, it seems like we are going to embrace the market economy finally. The independent central bank is a key institution, which means that they cannot print money. Interest rates are going to be market determined. Foreign exchange rates are going to be market determined. Hopefully, the SOEs also will have to compete in a competitive market environment. So after many, many decades, this will be an economy that will work on market principles, and the underlying principle is competition. So you will have very, very different outcomes that come, and for the 22 million citizens, actually it is going to be to your benefit. I'll stop at that, Shiran.
Thanks, Murtaza. We'll move into very specific questions. Some prepared from me, some already coming in from the participants. So keep sending those in, and let me try to mix some of those into my questions as well. So let me start off with Dr. Indrajit. I think someone in the chat has also mentioned the whole question of governance and anti-corruption, and the question of how do fiscal austerity measures and rationalizing social safety nets go together. What is the mechanism? But let me first ask you about the whole governance and anti-corruption related emphasis in the program, because I think this has been a huge cry from the public as well. And how does the IMF program address it? And does it put a lot of the emphasis on the Sri Lankan side to deliver? And does it even tie into maybe future disbursements as well? And do you feel if we do some of these things, improve our governance, that will also be a trigger to maybe attracting genuine FDI investors who might want to establish here as well? You're on mute, Dr. Indrajit.
Thank you, Shiran. Yes, this is clearly addressing corruption vulnerabilities is, as far as I know, a new area for the IMF. It may be have done this in other countries, but it's certainly the first time they've addressed this in such a frontal and direct way in Sri Lanka. There are a couple of very important kind of strands of work they have identified in the MEFP, Memorandum of Economic and Financial Policies. Now, again, I really want to reiterate what Murtaza said. That this is our document. It's the government of Sri Lanka's document. I remember when I was in the central bank, we worked very hard to get the new central bank. It is not somebody else's bill. And not only that, there are lots of other things also. It's basically measures that we would need to take, whether the IMF is there or not. But as I said, the advantage of doing it with the IMF by your side is that you can get financing to cushion some of the austerity that is inevitably a part of it. Okay, so what are they doing on corruption? One is there's going to be a governance diagnostic with IMF technical assistance. And knowing the IMF, they will do that extremely thoroughly. So we would need to basically, and I think they've also said that the report would be made public. So then it would be basically up to us, because the IMF is not going to take follow-up action on that. Now, I can think of a number of reports that were prepared, certainly in the time when I was in the central bank, and they have not gone forward. So this is good that this governance diagnostic is taking place, but what happens to the outcome of that diagnostic would be up to us, and we need to then decide what we're going to do with the findings. Then the second thing is, they are trying to bring up our legislation on corruption up to speed and have it basically symmetrical with what is in the UN Convention on Corruption. And as part of that, they would strengthen, upgrade the various provisions related to declaration of assets. The idea is to get the declaration of assets aligned with what the G20 has passed as global best practice. So these are, I think, all very important initiatives. But I must say, as to how effective they would be is in our hands. Because I've seen before there have been other, not this time, nothing related to corruption and governance in an IMF document, but in other areas there have been initiatives that have been taken, but which haven't really led to very much. So we need to use the IMF's technical expertise to produce the reports, to identify where we can improve things, but then it comes down to us to make sure we implement.
Thanks, Dr. Indrajit.
Thank you.
So we'll stick to the theme of fiscal, and I think there's a lot of questions coming on the restructuring as well, which we'll get into. But let me first ask Deshal in terms of, I think the key anchor for this entire program and what leads also to the restructuring is the primary surplus target of 2.3% by 2025. Quite ambitious. Are we realistic going to achieve this target? What steps beyond maybe simply the rates going up and maybe economic activity can get us there? We also see, interestingly, wealth and property taxes coming in 2025. Is there thinking on this right now from the Ministry of Finance, or is this something that will be built in as we go along, leading to 2025?
Yeah, thanks, Shiran. No, you're right. I think the fiscal reform is really the front and center of the program, because that is the front and center of the crisis or the economic malaise that Sri Lanka has had for a long time as well. A lot of the instability, the volatility that we've had in the macroeconomy stems from consistently weak fiscal performance, and starting with weak government revenues. If you look at our government expenditure, it's around 20% of GDP. That's not spectacularly high or low by global standards. But our revenue is exceptionally low. In 2021, tax revenue to GDP was around 7.3%. And that is one of the lowest in the world. So that is why the reform program also attempts to address that as being the fundamental driver of volatility, and therefore essential to address in order to come out of that of the macroeconomic weakness. Now, it is ambitious. There is no doubt about it. You're going from 5.7% primary deficit in 2021 to a 2.3% surplus in 25. It's a steep adjustment. But also, let's recall that we are starting from a very low base, right? You're starting from a point where we are at the lowest end in the world, and you're expecting to go from a 7.3% tax revenue to GDP to a 14% revenue to GDP, tax revenue to GDP. And that 14% is also not particularly high by global standards. That's fairly modest level if you look at it in global terms. But really where I think that this is got a chance of, is I would say it's not an unrealistic target, because that starting point is so low. So the way that this is being approached is to focus on the core taxes. So when you say core taxes, you mean corporate and personal income taxes, VAT, co-excise taxes, and having a robust structure of these taxes should be able to take us to do most of the heavy lifting. It's also important to keep in mind that a lot of the big adjustment has been done upfront. Because we are aware that is the most difficult to kind of carry forward to win public support. So that has been done upfront, so that you have time for these measures to then take effect and build into the targets that are expected going forward. But obviously, you cannot stop at just addressing the rates, right? So that is why over the next couple of years, there are significant efforts that will be taken to remove or rationalize the exemptions that we have. And we've, as Murtaza mentioned, the previous exemptions that we had on corporate tax have now been removed. Similarly, there are a lot of exemptions that you have on other core taxes like VAT. So eliminating these exemptions is also going to continue to also build into the overall revenue buoyancy. Tax admin measures are also an important part of this story, in terms of digitalization, institutional measures, and so on. That is important both in terms of enhancing tax collection efficiency and also in terms of widening the base of the overall tax structure. So all these things will be carrying on in parallel in order to ensure that your revenue targets can be met. And I think there is, I think that there is a good chance of being able to be able to get to that level. At the same time, there's also a lot of attention in terms of managing expenditure. We've seen it so far over the last 12 months or so. There's a lot more discipline when it comes to what gets financing or not, and a lot of that has actually come from simply a lack of choice. If you look at the fiscal cash flows, you cannot afford to provide cash for spending spending items that are not priorities. So automatically you're compelled to have a degree of fiscal discipline, and with the phasing out of monetary financing, that gets all the more established as well. You asked about wealth taxes. Yeah, so these are some of the new measures that are being looked at, and it requires a fair amount of thought and caution that goes into the design. So that design process will begin quite soon. The idea there is that you're able to ensure you get your expected revenue from those measures, but balance that off so that you're not at the so you do that without disincentivizing the deployment of capital as well. So that's a tough balance to strike. So it needs a lot of thought, a lot of caution in terms of how that is designed, which is why you see that it's set to be implemented a little bit later on to give us that time to be able to design it in the most effective way, balancing these different requirements. Let me end.
Okay. Thanks, Deshal. Let's move into, I think, the restructuring. A lot of questions coming in on the chat. Let me get Murtaza in first, and then maybe Bingumal, since we're talking a lot about the banking and financial sector stability. Murtaza, I think one of the key things, I mean, there are different factors driving restructure the model, which the IMF and so many others will be using in the DSA. One of the factors is growth, and growth is expected to be about -3% this year. You feel if we kind of outbeat that, there might be a little more room in terms of the parameter for the restructuring. And some also argue that we've been given about a 10-year restructuring period, which might be not strong enough for Sri Lanka. And you have only a 4-year IMF program. How do we balance both? Because this will be outside of an IMF program, but the remaining 6 years will have to be on our own unless we go back for an 18 program. And I think there are certain questions also in the chat, which is reference to your previous statement of how, if you do bring in the banks, how that will impact the financial system stability and what can be done to rethink of the depositors' interests as well.
Yeah.
A few questions back in one.
Okay. So let's start with the growth situation. Why they are forecasting such a large contraction even this year? Partly is that due to a greater fiscal effort, there's fiscal contraction going on. So the benefit that the economy got for so many years by the fisc being so loose, they were stimulating the economy. Now it's working in the reverse. So that stimulant is gone out and it is contracting economic activity. Second is that in economic growth, there is also, it's like running, if you run every day, you can keep running. But for a long time, if you get injured and you fall, you can't start running the next day. There is a process of healing. So this economy is massively damaged. People are leaving the country. You are having a brain drain. Firms have downsized. So to give an example, it seems like we are seeing green shoots in tourism. But hey, presto, you can't be ready for all the tourists who come here because most of the hotels are significantly damaged. They need renovations. They have lost key people. So because of that, our growth potential has gone down. Therefore, the recovery will be very slow. The second, and we are not going to get a benefit from, say, a commodity boom like Argentina got or Zambia got suddenly due to world factors that the prices went up and then it kind of bails you out because we don't have many commodities to export. Then comes the issue of whether there is a positive catalyst on the DSA. So one of the variables that they use is the numerator is the debt and the denominator is GDP. So the one component that contributes to reducing the debt is the primary balance. So if you have economic growth that accelerates, what happens is you have a tax buoyancy effect coming in. So it is when there is growth that people spend on discretionary items that have a higher incidence of taxation. And it's also when there is growth that companies make higher profits because their fixed overheads get amortized over a greater amount of revenue. So then the tax collection improves when you have growth, and that is why it's called tax buoyancy. So it can help in reducing the debt because you start running a higher primary balance surplus. On the denominator, a higher GDP brings down the debt to GDP. So that is the channel in which higher growth will impact the debt sustainability and improve it. So if you have a positive catalyst, and what I heard in the media is some of the creditors want some kind of warrant instrument that if the outcome is better than expected, then they also share in the upside. Last question you asked was about debt sustainability. I mean, if there is some kind of domestic debt restructuring, the implications of the banking system. So if you look at the domestic debt, there's about 4.2 trillion, which is owned in the form of treasury bills, 2.6 trillion owned by the central bank, the rest with the public. There's about 9.2 trillion in government bonds. Out of that, the last figures I had seen, 43% is owned by the EPF. There's about 30% that is owned by the banking system, with the NSB by statute forced to invest 60% of their assets in government securities, and there are insurance companies, etc. Now, the thing is that if you don't make the debt restructuring as widespread as possible, you have what is called the subordination problem. That some people are subordinated with a higher adjustment. To me, that's plainly not fair. So the more people that are involved in the adjustment per person is lower. The second thing is that there are shareholder funds and tier 2. So there are enough buffers to absorb the losses. But something that I discovered a couple of days ago when I went to a seminar, according to Basel III norms, if your rating starts deteriorating, when you are computing capital adequacy, you can, even for domestic instruments, you should not be zero risk weighting. So even before the default, if you take a domestic debt, which is now being downgraded to CC, you have to use a much higher credit risk weighting, 100 or 150%. So at the time of default, you might have to credit risk weight all your investments in domestic debt at 150%, even if you assume that they didn't default on you. But if that class of securities got defaulted, so that does more damage to your capital adequacy than the impairment charge that you're going to take. So therefore, I believe that some kind of regulatory relaxation or regulatory forbearance will have to be brought about. And it is also shown according to the accounting rules under IFRS 9, if you are accounting for these instruments in amortized cost and you do a debt swap using something called the regulated interest rate, that the new instruments can be recognized at their face value and you can avoid a day one loss. So there is a way around this. Sorry, I took a lot longer than I planned, but this is a bit more complicated to explain.
No, thanks, Murtaza, for the context. Bingumal, I think hearing Murtaza and others as well, and a lot of emphasis in this program is on banking system, asset quality reviews, then even liquidity, maybe capitalization being mentioned as well. Then, of course, the perimeter for debt restructuring has also been left. I think if you read the language, not really clear. What will it include? Selected pool, it keeps it quite open. And I know central bank is due to provide this clarity in April as well. Seeing all this and also seeing what Murtaza is saying, what is your views on all this?
Yeah, thanks, Shiran. So the first thing is, Shiran, the sector has gone through a lot of stress since Easter attacks. It's pretty much like the tourism sector, not to that level, but gone through a lot of stress post Easter attacks, and there were moratoriums, then COVID, and then the economic crisis. But after all of that, we've landed safely. Our capital ratios, I mean, if you average it, it's about 415.3. Our LCR is close to 200. Still, the industry is delivering a return on equity of 14%. And we are carefully monitoring this. And the LI, the NPAs are around 12% now. So because of high interest rates, we are managing. But this NPL is something that we're carefully monitoring. So banking sector has taken a lot of stress, of course. Also, the recovery process has taken time or postponed in most of the cases because of the moratoriums. So right now, the loan book has come down. We're slowly getting back to our clients and trying to lend to the important sectors. Now, the asset quality review was done to 2 state banks and 3 large banks. I think in a debt restructuring scenario, it's a very prudent thing to do. If I compare us with Ghana, where Ghana straight away went ahead and did a DDR announcement, I think we are trying to do this whole piece very methodically. So we've done asset quality review. So we are trying to understand the impact to the balance sheet, to the capital as a result of ISB haircuts, the provisions that we have taken. I agree with Murtaza. You cannot say it's zero cost. You are in default now, double C. So different banks do different things in terms of looking at ECL and how they look at provisions. But about DDR, I think now we have come to the final stage of this whole thing, and hopefully by April we have clarity, because I don't want to speculate. But looking at the historic data, we've seen like the last 20 plus years, about 100 restructuring. Out of that, 29 cases have gone through a DDR. Out of the 29, about 30% of that has gone through some amount of banking crisis. Especially in the T-bill space, we've seen the Barbados, the recent example in 2018. They did T-bill reprofiling, but Barbados is a very small country with 400,000 people, small economy. Russia did a T-bill restructuring in the early 2000s, and they ended up with a banking sector crisis. So what we had to understand, I agree with Murtaza, when treating creditors, you treat fairly, but we also have to understand, are we doing too much to a level where we cannot recover the whole economy, because we have to get back at least at -3 this year. Our assumptions are -1. We can even be flat. The growth is critical, not at the previous levels, but the growth is critical. So in a post-debt restructuring scenario, banks will play a significant role going back to our clients and extending balance sheet. Because right now we are managing this so well, because one, we are not settling our debts. We are also not importing. Our import bill has come down to 1.4 billion. Now there'll be pressure from WTO and all these geopolitical organizations for us to open up imports, because we've been holding on to this. Otherwise, we lose other trade benefits that we have. So moment we open up imports, we'll add another 400 million to this mix. So immediately there'll be pressure, because right now we are managing the BOP very well, because we have our shortage is about 400 plus million. We have 150 million plus from tourism and 400 million plus from worker remittances. We are managing it. Moment we open imports, we need to have a reserve buffer. So it's a very complex situation that we are in terms of reviving the economy. We believe that the bankers will have to play a role. We're not at all asking for a professional treatment. One will have to sit and understand the real impact to the economy if you touch the shorter end of the investment in the banking sector. Because one is getting a regulatory forbearance, that's very common, and say, okay, you can go down to 6% cap pad, and that's okay. The reality is not okay to say okay in a scenario for the banking sector solely because there are cash flow issues. If you have a bank run like in this country, will really suffer. So it's very important that, because we have managed this so well so far, and we have to navigate the next 3 months very carefully. I'm not advocating anything at this point. All what I'm trying to say is debt restructuring parameters have to be well thought through, and you have to balance it out in terms of what all the creditors are, participating in the contribution that creditors are doing, as well as the impact to the economy. So we are carefully watching. We have engaged these policymakers, and we basically presented our case. Of course, one got more than the other, even ISBs on T-bills. So each bank has a different case. We all have a different level of stress, but overall the sector is performing reasonably well. We are ready to participate in the recovery.
Thanks, Bingumal. And Deshal or Dr. Indrajit, anything you want to weigh in on the restructuring debate and discussion, or anything from the questions that maybe you want to clarify related to this?
Okay, I'll say a few things if I may. I think I do think there is a potential upside on growth, which would then reduce the effort needed to be made on the debt restructuring. Where is the potential upside? One, I think both of these relate to India and China. India, because clearly it's expected to be the fastest growing economy. It is trying to position itself as a global supply chain hub. So as we saw what happened with Japan and China, when they had a growth surge, countries in the region also benefited through supply chains. So that could possibly be replicated, which would give us an opportunity if you plug in India's neighborhood first policy into that as well. Secondly, I think China, what we need is not loans from them this time around, but for them to deploy capital, which they have plenty of. And for them to deploy capital, to leverage the infrastructure they've already built through loans, whether it's Hambantota Port, Port City, etc. I think the second round, if they can, if there are ways and means of ensuring that China invests, take advantage of the infrastructure they've built, I think that again is a potential kind of source of growth that can be triggered. So there are opportunities like that, which I think are relatively new and can give us the boost. Because, you know, if you look at the macro fiscal framework, as you pointed out, I think you or somebody pointed out, we have -3-4% this year, pretty flat next year, and then 3% for the rest of the 10 years. Well, I really think we can outperform that. I really think we can outperform that. I know the global economy may not be as propitious as we'd like it to be, but despite all that, as I said, because of these advantages we have in relation to both India and China, and you know, tourism again hopefully can be a low-hanging fruit that can be leveraged. So that should give us a little bit more space in terms of containing the debt restructuring that it has to be done, and therefore that could have a positive impact on the domestic debt restructuring. Then I think also on the domestic restructuring, one needs to take into account the fact that the domestic creditors have already taken a massive hit, both through inflation and through depreciation of the currency. They've already taken a very big hit. So when we have our negotiations with other creditors, that point, I think it will be, I know the authorities are well aware of that, and they would use that argument to try to work out the burden sharing in such a way that the hit that has been taken by the domestic creditors is built into the conversation. And thirdly, I think Mr. Murtaza did speak a little bit about this. There is quite a lot that can be done in terms of regulatory forbearance and relaxation of accountancy standards to help us to basically absorb the first day kind of shock and to find a kind of relatively smooth path to whatever trajectory of domestic debt restructuring is eventually agreed. So it is potentially a manageable. I don't think it has to be a disaster at all. As I said, growth can reduce the amount you need to do. We need to make the case that a lot has already been done in terms of the pain that the domestic creditors have experienced. And three, I think through regulatory and accountancy standard modification, one can provide the space for the domestic creditors to absorb whatever the effects of the domestic restructuring are.
Deshal, anything you want to add in? Yes, you're good.
No, sir, nothing specific to add on.
Sure. Just moving a little, maybe the final thing on the fiscal side, Deshal, I think, is on the public finance management legislation, which is also, I think, a structural benchmark under the program as well. Those who probably think maybe we don't need something like this would argue that we already have a Financial Management Act, and it's really the implementation of this that is really missing. Why do we need another act really in this situation? What does this bring in compared to what we already have and the framework that we have? And then maybe, I don't know if you want to comment about the Central Bank Act, or Dr. Indrajit want to comment about it, but there's a few questions on that.
Sure. Yeah, so just to correct that, so we don't actually have a PFM legislation in terms of the scope that is proposed in the program, right? So what we have now is FMRA, 2003 legislation that focuses more into, it's more of a fiscal rules component of PFM, whereas the PFM legislation that is being contemplated in this case is much broader in scope. So it addresses issues like fiscal transparency, a number of fiscal governance related issues, but it also does include revamped fiscal rules, because we all know that the FMRA has the kind of disciplines, has disciplines in terms of limitations on your budget deficit, limitations on public debt to GDP ratio, limitations on government guarantees, etc. But that legislation has been observed in the breach for the last 20 years. If that had been observed properly, we would certainly not be in the situation where we are right now. So clearly there needs to be a revamp of that legislation. So what is being built into the new PFM legislation will be fiscal rules, but with defined and time-bound exit clauses and other mechanisms to improve the likelihood of implementation according to that. But I think it's also very important the new elements that are brought in, particularly areas like fiscal transparency, right? So these are and also fiscal governance. These are areas that there's been a lot of public demand in terms of greater requirements for, but I think these measures also can help in terms of reduced risk of crises going forward. One of the problems that we've had is weaknesses in terms of transparency that has, led to that has facilitated a lot of the fiscal weaknesses that we have had. So I think this legislation will certainly go quite a long way towards addressing that. As you said, it's a structural benchmark. And it is one of the pieces I think that's important in terms of ensuring that the reforms that are going on do have a greater degree of longevity. It's impossible to be able to say, okay, whatever you do today will never be reversed going forward, but you need to do what you can to reduce the chances of a rollback of some of these reforms. So legislative tools like PFM play an important role, and also some of the institutional mechanisms like central bank independence and the legislation around that. So there again, the legislation for the central bank builds in or provides the foundation for greater institutional independence, but also very importantly, it eliminates practices such as monetary financing, which is again, I think an important part of what has brought us here. The fact that all this time the fiscal authorities have been able to, have relatively loose fiscal management, knowing that you have a backstop in case things go south and you're not able to meet your cash flows. When fiscal authorities know that, look, there is no last resort financing in terms from the central bank, you're forced to have a better degree of your fiscal management as well. So I think all these elements are important in order to ensure that the reforms that have been put in place now have a much lower chance of getting rolled back in the future. The third element in that, so I mentioned legislation, I mentioned institutional changes. The third element is, of course, public mindset. It's also important that from a public perspective, there's an understanding of why these reforms are taking place, that these reforms are in Sri Lanka's interest to address the fundamental problems that we have. It's not something that is being brought in from outside in order to do it, as Indrajit said at the beginning. These are the measures that we require to avoid getting to the situation where we were 12 months ago. So if there's broader public understanding of this, then again it reduces the chance of new measures coming in to roll back the reform process. I think all three of these elements are important in that regard.
Thanks, Ashra. We'll shift to the SOE piece, I think, which is also another crucial anchor of this program, something we've avoided doing. A lot of the things are repeats of what we should have done as well. And I'll bring in Murtaza, because you, I think, are part of the new agency and do a lot of work in this space through Advocata as well. Two areas, really. I think one question coming in even from the chat is, we're looking at divestment. Why are we divesting profit-making entities? What is the rationale for that? Shouldn't we start by divesting things which are not profitable and really look at stemming some of those losses? And the second thing is, what role will the SOE divestment play in both the restructuring and the debt sustainability, and in particular, meeting some of maybe the gross financing needs targets, things like that, because understanding is that some of the SOE debt is also now classified under these restructuring debts. Some of the SOEs may be on the bilateral side, which were previously more on the SOE side, have also given captured under a few bilaterals as well. Thoughts on those sides, both questions.
Yeah. So I'll first answer your second question. From my reading of the report put out by the IMF, any divestiture proceeds do not count in your primary balance targets. So for example, you go and sell something for 10 billion rupees. That doesn't mean that you need to collect 10 billion rupees less taxes. That's not counted. right? And the reason that it's not counted is because it's considered one-off and it doesn't indicate an effort in terms of a permanent resetting of the system. Of course, if you get large amount of money, you may be able to settle the debt. But the debt is so enormous, was it 30 trillion, that all these privatization proceeds are going to be a very, very small component of that debt. So it's not hardly going to move the needle. Then comes this question that is coming up all the time about why sell profitable companies. So let's start with what is profit. They are focusing on accounting profit. But economists know that their definition of profit is very different, which means that they also apportion of cost of capital. And it is a residue after charging the cost of capital to accounting profit. If there is a residue thereafter, that is an economic profit. So what we should be concerned about is, are these entities earning an economic profit? Because capital has a cost of capital. There's an alternate, there's an opportunity cost that if you don't put it to business A and it's not giving your minimum return, say, assume that in normal conditions, it should be about 15%, or it could be higher if it's a riskier business. If you're not earning that, then basic corporate finance would tell you is that this money should be utilized somewhere else that will give you a higher return, or in the case of government, a higher social return. Because it's not always the government will get an economic return, but if there's a social return. So that is the litmus test that you have to apply, not the simple accounting profit. Moving on, you have to ask yourself whether the government has been a good steward of these businesses. Have these businesses been run for economic efficiency, environment, social benefit? And unfortunately, the record over the last, 40 years that I can remember is the government has been an extremely poor steward of these businesses. Reason number one, that we have a highly extractive political class in this country, and SOEs are a rich place for economic extraction. So it's a place where you put jobs for the boys. It's a place where you rig the board with your people. And it's a place for leakages, misappropriation. The next problem that you have is that a highly constrained government, ultimately it is the owner who has a say of what is done with profits. Now, if the business needs to retain profits for reinvestment, but the owner is cash constrained, it is like we have a government at the moment, it is only natural that the government is going to extract those profits as dividends and deprive the business of reinvestment. So in the absence of reinvestment, you will basically weaken those businesses. And therefore, it is better to sell them now than say in 5 years, where the fiscal authorities have been forced to extract most of the profits as dividend because they need the money. The next issue that you have is that keeping these businesses in state ownership, even if they are reporting accounting profit, is the issue of competitive neutrality, because many of these businesses operate with private sector players also, and there are many distortions. I saw the question that came up in the chat box about the Indian insurance company. Now they're talking about Sri Lanka Insurance Corporation. 7 or 8 years ago, the regulator gave a directive. All insurance companies have to separate their life and general businesses. SLIC didn't conform to it. There's no reason. And when we asked the regulator, why didn't you take action? They said the only thing they can do is suspend the business. That means all the policyholders would be worse off. But all the private sector players, they separated their business. So that is an example of regulatory neutrality not being fair. That private sector businesses are disadvantaged because you have a state player that has a separate set of rules. And there are 4 forms of neutrality: tax, regulatory neutrality, procurement, and funding neutrality. And there are examples, numerous examples, where SOEs benefit from an unlevel playing field. And finally, basically, the government also has put roadblocks for the efficient running of these businesses. So in the 19th Amendment, there are so many procurement guidelines. And therefore, these businesses have to adhere to those government procurement guidelines. And there was a problem with Sri Lankan Airlines where they couldn't renew their leases because their procurement manual was not approved by the cabinet at that time, and the whole decision was getting delayed. So, to allow these businesses to prosper, and if they are to have the same playing field as private sector, you have to give them significant autonomy. But due to this thing in the 19th Amendment, they can't do that. They need to follow all the government procurement guidelines. That delays the whole process. So they can't move and are not as flexible as a private sector player. So it is not in the interests of our government to be a shareholder. And finally, the most important element here, even if these businesses are divested, like every other business in Sri Lanka, the government has a 30% claim to the economic interests of any business through the tax system. So if these businesses are better run, they are more profitable, they are in a position to pay larger taxes. And therefore, government that is earning more tax revenue can reduce the taxes for all, or they'll have more money to spend on many social things. So the case, the question I have asked, are these businesses an asset or liability? By selling these or restructuring them, you will convert a liability into an asset.
Thanks, Murtaza. Any other views on the SOE reform and what we need to get right this time around? Bingumal or Deshal, I think there's a follow-up question to on the fiscal accountability side. I think since it's also another piece of legislation, really it requires a lot of understanding and oversight by Parliament as well, which is at the end of the day responsible for public finance as well. What more can be done to this? Because I think we didn't really talk about what got us here, but I think what got us here is the lack of fiscal prudence, which highlights the lack of implementation of the FMRA and the missed opportunity of the central bank bill, which was brought in 2018-19 period as well. Mixture of those, fast forward 3-4 years is what got us here as well. But how do we kind of narrow this knowledge gap? Because I think the complacency could set in now that we are in a program. We don't need to really be as prudent. Maybe in a year's time, we'll forget all about the queues and all of that, and we try to go back to BAU.
Yeah, I mean, I agree. So as I said, legislation alone is certainly not enough. We have plenty of track records to indicate that just because there is a law, it doesn't mean that it can't get changed, right? So what can be done from a policy perspective is to put as many barriers to change as possible, right? So as I mentioned, the legislation is one part of the story. Then institutional barriers. So the example we discussed was in terms of the central bank. The fact that under the new central bank legislation, monetary financing is not possible. It doesn't give the Treasury effectively won't have a choice. You won't be able to run large deficits because you're not going to, and you're not going to be able to get that backstop from the central bank in case you can't raise cash from the market. So you're seeing that very in reality today. Today, the Treasury simply does not have the space to be able to release cash for expenditure because monetary financing has been brought down, has been phased out to a great extent. You simply just don't have that freedom. So you're compelled to focus your expenditure on the most essential items. So if you look at today's context, monthly salary bill is about 93 billion rupees, pension and samurdhi is about 28 billion, other essential procurement, medicines, fertilizer, etc., another 28 billion. Interest cost is about another 170 billion a month this year, and your revenue is only 170 billion or so, right? So automatically you just don't have the space to be able to spend on stuff that is beyond the essential items. So when you build that kind of restriction into the legal framework, into the institutional structures, you're kind of tying your hands, because I think a lot of concern that the market has, for instance, is that once this 4-year IMF program is over, how do you ensure that discipline going forward? So these are the kind of tools that you can use, but it's really none of it is foolproof, right? You will never have 100% solution, but that is really where I think the question had asked about, how do you build the knowledge and the understanding of legislators, and that is absolutely important. But my sense is that really what's important is for the broader public to understand. If you take examples from history, you look at why, say, a country like Germany, where citizens are so almost obsessed with inflation, is because of the negative experiences that they had in the immediate post-World War I situation, right? So we also need to build into our psyche a sense that, look, we understand what causes the kind of economic disturbances that we've had, and what we need to avoid doing in order to fall into that situation again. So that needs broad stakeholder engagement with it. It comes from government communication. There's a role for the media. There's a role for civil society, academics, and of course legislature as well. So it's not something that you can do overnight, but I think it needs this kind of concerted effort across multiple layers.
Dr. Indrajit, you have your hand up.
Yeah, thank you, Shiran. In the sense that, if I can talk a little bit about the monetary, the new central bank bill, as well as fiscal rules. As I think it was Deshal who pointed out that historically it's basically been macroeconomic stress that has basically held back Sri Lanka's progress over the last 60, 70 years. And the budget has been the main problem. And the problems of unsustainable fiscal performance has been compounded by fiscal forbearance in monetary policy. That's been there all along. So now the program that has been formulated under the EFF addresses both those issues in a front-through way, right? The PFM Act, I don't know what the nature of the fiscal rules are going to be, but I think it's going to upgrade what's there in the FMRA. And the one thing that I would really hope would happen, I don't know whether this is constitutionally possible, but to put in a provision that the Fiscal Management Responsibility Act, or the equivalent of it, within the PFM Act, could not be changed without a supermajority in Parliament. There are some countries which put in constitutional provisions which prevent indisciplined fiscal performance. Like that, if we can make sure that, in whatever is there, I hope the operating target for the new souped up version of the Fiscal Management Responsibility Act, in whatever form it is, will be the primary surplus. That will be what's targeted. And to change that, you have to have a supermajority. If that is possible constitutionally, I don't know. But I think we should aim to do that, because what we need to do, given our history, is to have these very clear frameworks for macroeconomic policy making, and then to embed them in law and make it as difficult as possible to change the law. Then the second thing is on the new central bank bill, an interesting observation, though I'm not able to substantiate it through evidence-based kind of research. We've only had 4 years where we've had a primary surplus in the budget, right? A couple of times, I think once in 54, then somewhere around the 70s or something, and then 2017 and 2018. Now, in 2017, the Monetary Board took a decision not to participate in the primary auctions. Though there was no new monetary law act or no legal provision that authorized it, the Monetary Board has the power to essentially set policy for the government. And it took advantage of that to say, okay, we will not participate in the primary auctions. Now, after that, there were 2 occasions when we were compelled to help the government. One, because to pay salaries around New Year in 2018. And the second time, to help to pay for the bond, the ISB, in the beginning of 2019. Other than that, I don't think it made the central bank very popular in the treasury, but that helped, I think, to discipline the fiscal outcomes sufficiently for us to have primary surplus. So it seems there is actually real evidence which gives credence to the fact that if the central bank does not indulge in deficit financing, you can actually get a better fiscal outcome. The second thing is, financial repression was the second kind of means through which fiscal dominance was exercised over monetary policy. In fact, I think recently there was the 1 year Treasury bill had a 5% cap on it, I think, and which really distorted the whole yield curve structure. And in fact, it has even caused, I think, a lot of hardship to families and households because people went and took credit and indulged in all kinds of things, which is now having a kind of boomeranging on them. So again, having this flexible inflation targeting framework, running evidence-based, data-driven monetary policy, which is forward-looking, I think hopefully will prevent us from indulging in the kind of financial repression that we have done in the past. So the proposed the proposed central bank bill addresses those two big issues that have compromised macroeconomic performance in the country. And also the governance structure, I think taking the government, other than the governor, there is no government member in either of the two governance structures, which is a step forward. The way the members of the two governance boards are appointed, I think could be somewhat better in terms of distancing the central bank from the government. But still, I think quite a lot of progress, I think, can be made through this bill. And I think sometimes, one shouldn't allow the excellent to be the enemy of the good and take what you can when you can. Thank you.
Thanks, Dr. Indrajit. Bingumal, if I bring you in here, listening to some of the fiscal and monetary reforms that are coming in, does that inspire confidence as a banker that maybe the financial system, the banking system can go back to maybe a lower cost of financing, in particular for firms and the public? And does it also inspire confidence on the currency as well? Because we've had, instances where we've really squeezed or held on to the currency and then it's just imploded. So that when it was at 100, 110, 130, it seems we don't learn our lesson at all, and now we've ended up at 350, 360, and back up again. So does this inspire confidence, in particular being a foreign bank and seeing what you have in the region? Because this is one of the fundamental reasons maybe investors don't want to come in, is because of the high degree of volatility, both on the interest rate side and as well as the currency side.
Yeah, the first point is, I agree with Dr. Indrajit that the fiscal policy, if you can put it under the constitution to change with the supermajority, I think that might work. I think Bulgaria, if I'm not mistaken, have done it. There are countries that have done that. I think it's very important because we can't trust the system even for the future. Anything can happen in 3-4 years' time. Somebody can come and say, I'm going to take the debt to GDP to 120% or something like that. So we're very conscious about how we really, seal this properly. So in future, we don't see these surprises. On the interest rates, sadly, because of the inflation, we had to go into a major tightening cycle. So interest rates were taken up by 100%, but the bond rates went up beyond 20 to 30+% at some point, solely because of the uncertainty. So I think there's some amount of haircut being built in the prices. Now it's hovering around 26, 27%. So moment we have clarity on debt restructuring, hopefully by April, these rates will fall. There's no doubt these rates will fall. With whatever format you take, the rates will fall. So therefore, we are eagerly waiting to see the client interest rate coming down to something like 15%, because anything above 15%, you can't, borrow and do a business. So your ROEs have to be like 35, 40% for you to be in business. So it's very unrealistic. So we have to bring it down to a reasonable minimum 15 to maximum 15, I would say, for the corporates, but maybe SMEs can be slightly higher to do business. So that will happen this year. Interest rates will come down. And in a tightening cycle, as global banks, we understand these things can happen. In Ghana, I think it's about 20%. So especially in the African markets, we've seen the mid-teens to 20s. So it's not surprising, but I think we are coming out of it really fast. On the exchange rate, sadly, because we capped the exchange rate and suddenly we opened it and it was a free float. Free float after capping without support is a free fall. That's exactly what happened. Currency depreciated by 80% overnight. Sadly went to 370 and came down. Now, from a nominal standpoint, we've taken a massive cut, 80% depreciation. An emerging market currency like LKR would generally depreciate by 5 to 7%, worst case 10%. So even if you add 10% from 200, it would ideally sit 270, 260, maximum we say 300, if you really look at it from nominal terms. But from a real effective exchange rate, because the inflation, rupee has actually appreciated from exporters' point of view, and it's not lucrative because they are competing with the other neighboring markets, their suppliers, their buyers, those markets. So we have to strike a balance. This yo-yo is not good. It went up, came down, went up. So I think we have to manage it. I think the sentiment being built before IMF, and we took the currency band away, we took the mandatory conversion away, and of course we have restricted imports. Imports are just 1.4 billion, and most of these imports are actually on cash payments. So we don't have many LCs in the system, so we don't have a lot of trade payables. So as a result of that, less demand, so currency appreciated. Our Standard Chartered Bank view is always our view was like the rate to be somewhere around 350 and to end up at 325. We believe that the currency will appreciate post debt restructuring, and of course after that it will take up again at 5 to 7% level. If the currency is depreciating by 5 to 7% at that level, interest rates at stable level, I think it's a good mix, because we also have to understand the US rates are like 5% plus. It's very easy to park everything in the US and be happy. So if you're trying to attract those investments into the GSEC market, we can't come down to single digits, sadly. We'll have to keep the interest rates at a certain level to attract those investments and stabilize the exchange rate and depreciate accordingly as per the market norms. Good news is less intervention from central bank. So therefore the market forces will decide where we will land. And we think something around 300 will makes a lot of sense, because that will also help to control inflation as well as revive the economy. So that's our stance on the rates at this point.
Shiran, if I can have just one word regarding the interest premium, rather regarding the risk premium built into interest rates. My understanding is that the governor and the ST will be speaking on some of these issues next week. So hopefully there will be more clarity next week.
Sure. Let's shift into the theme of exports and investment, and I think the nexus between the two, because that's something we've really missed out in the past decade, and we've really seen a lot of debt world investment, and one of the triggers to where we are. There are a lot of questions in the chat box as well in terms of export competitiveness. How do you incentivize exporters when there is no preferential tax treatment or rebates or anything like that? How can we encourage exporters? How can we encourage investors to come in as well? Any thoughts from the panel? I'll leave it open to anyone who wants to take it up. Murtaza, go ahead.
Yeah, I saw that question come up. So the detriment to my own family's business. Let me explain the tax issue. Say you are a tea exporter, and the tea exporter says, my tax rate used to be at concessional rate, now I'm at 30%. For a moment, you grant that tea exporter that, because you're only the last final point in a long chain. So the guy who grows the tea says, I also must be given concession, because without my tea, you can't export. The guy who basically converts the green leaf into black tea is going to take the same argument. So is the broker, so is the transporter, so is the person who stores the tea, person who packs the tea. So that argument that exporters should get a concessionary tax rate does not make sense. It should be one rate across the whole economy, because the exporter is not working in isolation. He's part of a large supply chain and an ecosystem where there are so many different economic actors that contribute. Is just the last point before it leaves the country. So that argument that the exporter should have concessional tax rate does not hold. What is most important to an exporter is a competitive exchange rate. Our currency came down 85%. It has jumped back, but still we came from 200 to 320. It's supposed to be a market determined exchange rate. People will have different views. in 3 to 4 months, we will see what the natural equilibrium point of the exchange rate after we relax all these import controls. We have for many years maintained overvalued exchange rate because there has been a misplaced notion that a strong country needs a strong currency, but that has been a complete bias against exporters. We have corrected that. So that is the most important condition to encourage exports. The second condition is that you need to, the thing that will drive exports going forward, a whole bunch of sectors we don't even have now. As a Harvard team that was advising Sri Lanka in 2016 to 2018, Professor Ricardo Hausmann said, the export champions of your country in 10 years are companies that don't even exist today. And if you look at the success stories of countries like Thailand and Vietnam, the entire export structure changed, that they got a whole bunch of new items in their export basket that they never had. And it is highly unlikely that the businessmen in Sri Lanka are going to be the champions behind those companies because there is tacit knowledge that we don't even have in this country that has to come either through FDI or it has to come through the brains of our diaspora who have tacit knowledge, who can bring it to Sri Lanka and help us develop those industries. There are two conditionalities in attracting such kind of investment. It has nothing to do with tax. The first thing is that you need trade treaties. This is another thing that we have vilified, that every time that we try to sign trade treaties, people went and protested and said that it will be at a detriment of the Sri Lankan economy, which is completely a myth. So the first thing is, if you take countries like Vietnam, they have over 30 trade treaties. I believe we have 3 or 4. So we had to expand the base of trade treaties, which means that countries to which you export, there will be no tariff, extra tariffs against your export, which takes a huge barrier against exporting. The second thing is, if FDI, especially goods FDI comes, it's too difficult. It's best that they go and plug and play into industrial zones. We haven't built any new industrial zones for many, many years. And the existing industrial zones that we have are operating at like 90%, 100% occupancy. So we should encourage private sector industrial zones where even investors will bring in new investors into the country and then exploit our labor, etc. Those are two key ideas that we have to catalyze to improve exports.
Thanks, Murtaza. I think the latter idea of investment zone is what drove a lot of Thailand's exports as well. Deshal, quick views on that.
Yeah, thanks. No, I just want to add to one thing Murtaza said. So I think one of the problems that we have seen in Sri Lanka over the years is that we've tried to use taxation to address all manner of problems, right? So whenever you have a situation where there is if you want to attract investment, if you want to encourage a particular sector, the answer has always been, let's give this sector a tax concession. Let's give these investors a tax concession. And that is one of the things that has contributed over the years to this erosion of our tax base. Our tax to GDP in the early 90s was around 20+%. And one of the factors that has led to this coming down to where we are today is that we have been using tax as a tool to do all other policy objectives. So there's, as I said, there's investment, it's all manner of things. But that's the wrong approach, right? So I think we cannot afford to do that anymore. What we should be focusing on, okay, if you're trying to address investment, then address the problems and the bottlenecks to that sector, whether it's land, as Murtaza said, whether it's the access to labor, the access to talent, all those things. But we have chosen the easy path, and instead of doing those difficult, more complex structural reforms, we have chosen to go by various tax concessions, and that's really what has contributed to us getting here. So we need to move away from that, stop mixing up these policy objectives. There was also a question in the chat about taxation of professionals. So I think this has been a complex issue that has been discussed in great detail. So government authorities, I think, are very conscious of the challenges that have been that people are facing because of the combination of various measures at the same time, right? Whether it's the increase in interest rates, the taxation, adjustment of utility prices, all of this has happened at the same time. That naturally creates significant pressures on people. And I think there's an awareness, there's definitely an awareness of that. But the way that the income tax structures have been designed is by looking at official Sri Lankan data, right? So the official Sri Lankan data for for incomes is the household income expenditure survey. The 2019 survey is the most recent data. Those figures were inflated to account for the increases in prices since then, and it was based on that the existing tax structure with a tax-free threshold of 100,000 rupees per month, that affects only the top 20% of households in the country, right? So we must remember that we are not making these adjustments in the context of an ideal situation. We are doing this from a position of sovereign default. We are doing this from a position where we are negotiating with global counterparties. And it's very difficult for us to ask our global counterparties, whether it's our creditors, to take losses on their loans extended to Sri Lanka. And in the case of official creditors, these are loans that are using their taxpayers' money. And if we are unable to say that, look, even our top 20%, our top 10% of our citizens aren't, willing to, aren't able to take their share of the burden, that makes it very untenable in terms of having that overall structure when you're dealing with global counterparties as well. So that is why the tax structure has been designed in a way to protect the vulnerable communities as much as possible, and to have the burden shouldered by those who can most afford it. And of course, going forward, as we discussed earlier, we're also introducing there will be introduction of measures of wealth taxes and so on as well, so that those other progressive measures will ensure that overall the tax structure is as progressive as it could be in that context.
Thanks, Deshal. Let's move on to, I think, one crucial aspect is in the intermediate, getting other financing in, which is either the World Bank or the IMF coming in. And I think in the staff report, it mentions about 900 million coming in this year. How soon can we really expect it? Are there any prior conditions similar to what we needed to do ahead of the IMF program? Are those also in place here? Can it also be used for budgetary support so that eases the pressure on domestic financing of the deficit as well? And what kind of areas would these kind of financing also catalyze? I know maybe it might be SOE, it might be the welfare benefit schemes, things like that. Dr. Indrajit and Deshal, maybe on that.
Okay, so in terms of multilateral flows, if you look at the program over the 4 years, there seems to be provision for about $7 billion of inflows from the IMF. There's about 3 billion there, plus other flows from the World Bank and ADB. So multilateral flows will be about 7 billion over the 4 years of the program. Now, for the first year, you're going to get probably two tranches of the IMF program, which is likely to be about, 660-70 million. The World Bank, the first year provision is for about 600 million, and that's split into 3 pots. One is direct budgetary support, the second is the social security net, and third is support for the financial system. I'm not quite sure what the breakup is. And what is interesting is a component of that 600 million will be on concessional terms, will be on IDA terms. Because, we have this reverse graduation. I don't think we're going to get all 600 million out of IDA, but a fair share of that will come on IDA terms. And it is for those 3 purposes. ADB also, I think, is going to give money for the social security or social safety net. Deshal will correct me, I hope, if I'm wrong. And I think out of the ADB, there could be about close to $1 billion in year 1. So say $1 billion from the ADB, 600 odd million from the IMF, and 600 also from the World Bank. That will be the year 1 flow of multilateral money. And as for how much of it will be budgetary support, but let me talk about the IMF money first. Unusually for the IMF, they have said that part of the EFF, rightly not, but they haven't specified that. They have said that EFF can be used either for balance of payment support, as it is traditionally used, or if necessary for budgetary support as well. So clearly in our situation, that is a flexibility that is very welcome. Then World Bank, as I said, has 3 pots, one of which is budgetary support. As to how quickly that money is coming, I don't know. Deshal may know, because I know there are some prior actions that have to be done to get that money. How far we are down the line of implementing those prior actions, I'm not sure. But again, that, you know, the World Bank has been working to disburse money as quickly as possible after the EFF. And I hope we have been able to help them to do that. So let's see how quickly that comes. And ADB also. I know everybody, in fact, there was a meeting, I think in November, where all senior multilateral officials came down to Colombo with the view of seeing how soon the World Bank, ADB, and even AIIB would come in behind an EFF. So that everybody is working hard to get that money in quickly. So as I said, 7 billion over the full program period, and a fair amount in year 1, 2. So that's just multilateral money. And as Deshal said earlier on in the conversation, one of the main advantages of the fund program is the boost to confidence and the reaction of market players, the ability of banks to get trade finance, credit lines for other reasons, etc. All that is going to be facilitated by the fact that we are now in an IMF program. So all this will really add up to a significant amount of inflows and hopefully confidence for people to look fresh at the Colombo Stock Exchange, government securities, and slowly, I think, FDI will also begin to recover.
I think we've already seen close to about 120 million coming into the local government securities market since about the mid of February. Deshal, anything you want to add to the World Bank and IMF, and in particular, I think the reserve target is 4.4 billion by year end, and we can only, the central bank can only buy 1.4 billion in terms of net purchases. Already, it might be already around 900 million at this point in time. How do we get to 4.4 billion? Is it mainly through these multilateral flows that will come in, or is there more support? Because there will be outflows. Maybe the swap with Bangladesh, maybe some of the RBI payments that we borrowed last year, which may not be in the restructuring pot that we will undergo as well.
No, so I think Indrajit was right in that I think all the stakeholders are doing what they can to opt to expedite these inflows as quickly as possible. There are certain prior actions that are required for these to be realized, but as I said, both from the authorities side and from the multilateral agencies side, efforts are being made to bring this about as fast as possible. It's of course difficult to be able to predict exactly when the timing of that would be. In terms of the central bank, they would be able to purchase. I think the figure is a flow. Sorry, is a ceiling and not a flow, right? So sorry, is a flow and not a ceiling. So they would be able to purchase from the market. And I think any overperformance also would be expected to be saved and to contribute to reserves. So I think this is it's a good time to be able to build up reserves. We've already seen fairly good progress in the first few weeks. But as Indrajit said, it's just a range of potential capital flows would also be able to contribute. Very difficult to be able to assign numbers to those. A lot of that is driven by sentiment, by confidence. But if we continue to make good progress in terms of the reforms, in terms of having good outcomes, I think all these other kind of positive impacts, positive inflows will feed on from that, and we really could start to see some kind of positive virtuous cycles as well, which we have seen particularly in say the forex market in recent times. So I would think that we need to focus on getting the basics right, making sure we don't deviate from the reform path, and I think the good outcomes will follow from that as long as we are able to do so.
Shiran, if I may do a quick follow-up, in terms of the money owed to the Indians, which was provided, last year, I believe that we are trying to negotiate essentially settling that money over a 5-year period. So there is the RBI swap that I don't think we will have 5 years to repay the 400 million. But in terms of the ACU payments, we try to restructure in such a way that I think our request from the Indians is to settle it over 5 years. But that's, I think, still at the early stages of negotiation. And same with the $1 billion line of credit. So all that will kind of, I think, be put together, and there will be a negotiation to settle it over time. So, and in terms of inflows, I think there is negotiations also underway to secure a swap, Indian rupee swap from the Reserve Bank of India. The amount is still uncertain. It could be up to the equivalent of $1 billion, but I think that's also still being worked on. So that's a swap, Indian rupee swap, which will facilitate to clearly facilitate Sri Lanka-India trade.
No, thanks. I think that those were useful and useful clarification by Deshal that it was a flow and not a ceiling, because I think that was a lot of concern because we've already almost met 3/4 of that target as well. I think we're into the last few minutes of the conversation. So if anyone has any closing remarks, maybe a quick one to everyone. Are we confident that we won't see an 18 program in a few years' time and we'll really do a lot of the more difficult things here? How confident is the panel at this point in time? And maybe any closing remarks by everyone. Maybe we can start with Bingumal and then go on. Or anything else you would like to cover that we missed out, or reply to any Q&A questions?
No, I think we only have like 3-4 minutes, Shiran. I think stay on course, not to go back to the past and do those things that we did in the past. And we have to deliver on what we have committed. It's not about IMF telling us what to do or our program being signed by IMF and us implementing. As a community, we need to understand that we're living on the edge for like good 60-70 years on fiscal stimulus, subsidies. We have to get out of that. If we don't do that, and if you don't bring the governance into the equation, we will fail again. There's no doubt about it. Cautiously optimistic.
Sure. Murtaza.
Yeah. So to your question, there will be an 18th program. I'm fairly certain about that. And the reason I'm certain about it is that the 17th program has set an extremely ambitious target of 2.3% primary balance surplus in 3 years' time. The highest primary balance surplus we ever achieved was in 2018, which was 0.8% of GDP. That also with certain amount of arrears. The targets are too ambitious. It's impossible. It's a swing of something like 6% of GDP. So we went from minus 4% of GDP primary balance deficit last year to 2.3% in 3 years, right? So unless they revise some of these measures, it is highly likely that we are not going to be able to complete the program and we'll have to renegotiate a new program. The reason I'm being this what negative is because it's not the lack of tax policy, but it will take a few years for the economy to recover. So all this work that is being done on structural reform, whether we are going to improve the labor code, whether we are going to improve the allocation of land, whether we're going to get investment into the country, SOE reform, all this is going to take many years. You can't do it in months. I would think that minimum, even if you work on it really hard, at least 3 years. And then you have to give some time thereafter for it to start taking into effect. We will have a bounce back. Definitely, we have contracted, and that bounce back for us to then start growing will take many years. And therefore, I am not optimistic that the recovery will be very strong, very fast. But if we lay the foundation, we are laying the foundation for a new beginning. And there, I am optimistic.
Thanks, Deshal, and then Dr. Indrajit. You're on mute, Deshal.
Yeah. So I take a different view to Murtaza. Look, I think given why I think that this time different is the fact that we have gone into a crisis that is not something we have experienced in the past. So I think the likelihood of pressure to significantly reverse policies, I think that will be probably less than what we have seen in previous instances, and also the memory of what we went through in the course of last year should give enough impetus to stay the course to as a great extent as possible. I agree that the targets are indeed challenging, but given the shifts in the institutional framework, the shifts that we're seeing in the legal framework, I am cautiously optimistic that the targets can be met. And I think there is enough and more incentive across the board to get that together. And I think all stakeholders need to view that in a collective manner, because if we miss our chance this time, it will be very difficult to regain confidence of the global market and the international community once again, because we have for too many times we have failed to demonstrate credibility, demonstrate the required discipline to be able to reset the economy on our own. So if we don't do it this time, I think it really puts us in a very difficult wicket going forward.
I mean, I must say, I very much reiterate what Deshal has just said. And regarding, maintaining confidence, it's interesting to recall that when we changed course or decided to change course, it took the IMF quite a long time to take us seriously, to believe us that we really are planning to change course. They just initially didn't believe us. You can't blame them, the way we had behaved. So this time again, if we mess it up, they're compelled to come. Their whole kind of terms of reference is to help countries in trouble. But it will be much, much more difficult. But I have a somewhat more optimistic kind of outlook. One is, I think I agree with Deshal that the crisis hopefully has brought about or is bringing about a change in mindset, both amongst policymakers as well as amongst the people. It may take a bit more time, but I think hopefully we are on our way. But really, I think there will be another program, definitely, but it will be to support a continuation of the reforms, not to support another debt restructuring.
Sure. So on that note, if I sum up, I think the key phrases sound like a boy band album release rather than an economic discussion. We are not out of the woods, share the pain, and stay the course. So it seems like a breakup to a long-term relationship album. So I think there's a very poignant takeaways, and let me thank all the four panelists for their remarks, very concise as well as very forthright, and I think views from all sides of it. And let me thank the participants as well. We've got a whole heap of questions, and if I didn't answer your question in a very specific manner, I apologize, but we try to kind of summarize it with some of the other areas that we wanted to focus on, which was largely on the fiscal side, I think on the SOE side, on the corruption and governance, on safety nets and export competitiveness, which kind of are the key anchors of this IMF program, and overall what the country also needs to aspire and move towards. So thank you to our panelists, and thank you to the audience, and let me hand it back to the CBSL team. Thank you.
Yes, thank you very much, Shiran. I believe it was very rich in content, and our viewers must have gained a lot. So thank you once again, Shiran, for steering the discussion in a very, very interesting way. With that, we are about to conclude today's expert panel discussion. On behalf of Center for Banking Studies, let me express our gratitude to Dr. Indrajit Coomaraswamy, Mr. Deshal, Mr. Murtaza, Jafferjee, and Mr. Bingumal, Thewarathanthri, and Shiran, Fernando for their invaluable contribution for this panel discussion. And thank you very much to all viewers who joined with us via Zoom and Facebook, who finally made this event a success. So Center for Banking Studies will continue to organize more events of this nature in future too. So keep in touch with us. So we'll meet once again soon. Thank you very much. Good evening to all of you.
Thank you. Thank you very much.
Thank you.